Hi, everybody. This is Gary Dean, and this is our weekend video report for Sunday, October 2nd, 2016. Hope you guys are having a fantastic weekend, and let's get started. So we saw a massive rally on Friday, and we were pretty oversold. We did have some bullish divergences on the short-term charts, and the rally actually made sense because it held support. Did I think it was going to be as high as it was? No, I didn't really believe that was going to come like that, but it's that's my mistake because we're in an all out environment, and Friday was a day to be a buyer, and if you're smart, or if the bulls are smart, whoever bought on Friday, they should take profits, because anytime you try to hold on, whether you're a bull or a bear, for a bigger move, you're getting wiped out. And we're going nowhere fast. And what's happening is we're getting whipsaw moves back and forth. So this is the longer term chart. I'm just going to go over the bigger picture here. And what this is showing is that what is pending, whether this wave one is complete or not, the next move is going to be a wave two down that could take the S&P as low as 990 and still be a bullish wave count, because wave twos can retrace 78% of the entire move. So I don't know when it's starting. I don't know if the one is complete yet. I don't, this is just a bigger picture view, just so you can kind of get a sense on if the market does roll over in, whenever to this next month or next year, not to be too quick to buy it, because most likely we're making that wave two down. But once this completes, the wave three should take out whatever highs that are made here and blow by them, because as you can see, these wave threes are the strongest moves right here. So this would be the next, after this wave two finishes, it would, the wave three would be an enormous rally like that. So again, I'm not sure if it's complete or yet, or the market's going to let us know that. There really is no easy way of trying to figure that out. It's more, just keep an eye on it and react. So daily chart. This is a bearish wedge right here. Now, do they have to come up to the top and touch it at the 2230? Maybe. If they, that means they're going to have to make a move, and they have not. They haven't reset the technicals or the momentum going all the way back till June. So I meant February. So this is a really big move without any complete resets of momentum. And when they try to move things higher like that without anything like that, what happens is it's like trying to start a rocket in midair, because you don't have any ground at that it's thrusting off of. So you get pops on it, but usually it drips back down, and that's because they've had no reset on things, and every big rally we see is getting sold, and every time we see sell-offs, we're seeing rallies that come after it. So the volatility is good. I welcome it more than I love this type of market rather than the grind higher and it's boring. This is pretty fun. You just have to be disciplined and take profits when they're there. So if this pattern breaks down before getting up here, then it just means that it's complete right here. This was just a back test before we take it out. But this pattern is calling for the S&P to head someplace down between the 1956 and it even could go to 1890. Now, again, is it going to do that? It would make sense, but it's just a pattern, and I'm just showing you the targets. So they have to break this pattern, and the most likely the target would be down here, and it probably would be in a very fast manner. That's just the way this market moves. So we have the bearish divergences, still pretty overbought with the momentum. If we take a look at the 60-minute chart, we have bearish divergences on the MACD. As far as the stochastics momentum indicator, it's tough. It's not, may not be the perfect one yet. But if we do head higher and take these highs out, this is where there's going to be a real nice bearish divergence, and that's not really that far above. We're talking 2180, and that's only 12 points above where we are right now. And the one pattern that I've been showing has been this triangle. And every time we've come to the bottom of it, we've seen big rallies, and every time we've been at the top, we've seen big drops. So it's we're pretty close to the to the top of this this triangle here. We have some bearish divergences on the MACD, and even if they try to gap over it, which they normally do, I think it's going to be a bull trap, and what they're actually going to do is close this gap, maybe even come up and try to close this gap, lure all the bulls in for the rocket ride higher, and from that they the big boys pull the plug. Now, why do I think something like that would happen? Well, I mean, here's just another day with the S&P was green, and you can see the total money flow was hugely negative. So the big boys were selling the rally on Friday, and that's what it's been almost accustomed that any big rally they're selling, and any big drop they're buying. And on Friday they were net sellers, and you can see it was money flow was really, really lopsided. So let's go back and go to a 15-minute chart here. So let's go. I'm going to do this. So we have the gap that's at that 2176. It didn't really fill it. And then the next gap would be up at that 2180. So these would be the next targets. And again, I still think I prefer shorting rallies right now. I just don't really see the internal strength that we should be seeing if this thing is going to break out to the upside. And plus, we still have the uncertainty of the elections, and I don't think that big money is going to come pouring into our market until at least that's is behind them, and we still have another 30 days before that's there. So I don't think they're going to be breaking out. If you take a look at the 15-minute chart, these were the support zones. I said that the buyers kept coming in at the first support zone. If they broke it, then we're probably coming down to the 2030, 2020 area. And they tried to pop up above the first resistance zone here. Now, if they get that, that's where, like I said, we're probably going to see them try to close this gap at the 2177, 2180, and that will put them into the second end of resistance. And then from there, I wouldn't be surprised to see him come all the way back down to these levels here. So if you're long, great trade on Friday. I wasn't short. I'm cash right now, and I'm waiting. But if you're long, you had a great day on Friday. Don't overstay the welcome. And what I mean by that is, you have profits, take them. This is not a the buy and hold for more than 3 days. You're losing. So take profits when you have them. Wait for the next setup. But we have bearish divergences here, very overbought. We're at the resistance. So I think the earliest sign that things will be, the bulls are losing it, will be if they can push it through this the 2161. That's the earliest sign. If they do that, then we're probably going to see a move down to the 2149 or even lower than that. And remember, I've been showing you the upside gaps that are open. We still have a ton of gaps that are on the left on the down going up on it too, that are down here. So I do believe they get closed as well. So if the bulls can push it through this 2175, my guess is they're coming up to this 2180. That would be where you want to, if you're looking to short, where you'd be interested in shorting. And really, what the main thing is just putting a stop at that above the 2193, because if it is gonna go up and say touch the top of that wedge that I was showing you, you don't want to be short from 2180 all the way up to 2130. It would be brutal, and you'll probably end up covering your short as soon as it's about to reverse, and you'll miss the move. So you want to have, when we start getting up to these levels, I think it would be okay to short, and you just use that 21.93 as your stop and see what happens. The last time we were here, this was a fantastic trade. I made a lot of money on it, and I wasn't risking that much, and it ended up working out fantastic. So bearish divergences on the 15. If we take a look at the 5, support-wise, you have this 21.63. That's the 38% retracement. It's also support here, and it's also a moving average. So, again, this may be the first sign that things are breaking, because if we break this support, we're probably coming all the way down to the 21.51, or even down and testing this 21.45. And if we start breaking these lows, that's when things could get bear ugly. So, right now, I would definitely be leaning more on the short side. Let's just see how things open up on Monday, and from that, enjoy the rest of your weekend, and I will talk to you guys in the morning.